So we are here today with Amit from Goldman Sachs. Amit, thank you for being with us here today at Termgrid. We'll get right into it.
Thank you, Dipish, for having me.
The industry estimates project the market to go from 1.7 trillion to 25 to 40 trillion. Where do you see the pockets of opportunity as it relates to direct lending specifically in that growth of the market?
I think we see a lot of secular growth over the next 10 to 15 years in direct lending. As you said, private credit more broadly defined, there are various estimates, including the numbers you gave, and that encompasses everything from direct lending, investment grade private credit, asset finance, and all of these are very wide lanes that we at Goldman Sachs are very bullish on. Double clicking on direct lending itself, I think we see continued growth in the offering. It feels like we're maybe halfway through what is a structural shift in the way borrowers are thinking about capital. And it doesn't need to be a sort of one way or other street. It doesn't need to be either private credit or public credit. But certainly the penetration of private credit is growing. We think that it can probably double over the next 5 to 6 years. And it is a very exciting opportunity which benefits both the investors into the asset class, but also the borrowers. And obviously it's the fact that both the borrowers and the investors into the asset class find it appealing, which is why private credit and direct lending specifically has grown the way it has.
If you were to focus on the deal profile of a typical private credit deal, it used to be that it was a company which was 100 to 150 million EBITDA that is going and accessing the private credit markets. That evolution has changed quite a bit, over the years. When will we see the first $10 billion private credit deal?
Yeah, good question. Look, as you said, 5 years ago, if you'd asked me what is the size of EBITDA, the largest EBITDA of a company that goes purely for a private credit solution, I would have said that's $100, $200 million. If you look back at some of the large deals that have been announced in the last 2 years, there are businesses with EBITDAs close to $1 billion, which have gone for pure private credit deals. And then you have hybrid deals as well, where you have a publicly syndicated component, and then you've got a private component, which could be in the form of junior capital, which has always tended to be a private credit battleground, or it could be capital that sits private capital that sits alongside public credit. And so I think, in terms of how big can deal sizes get, well, we've seen deals close to $7 billion in Europe of private credit for enterprise values of $14, $15 billion. And I think that will continue to grow. I think there are two core drivers for why that's growing. One is, deal sizes overall are getting larger, particularly as we get back to a more renewed sponsor M&A environment, more confidence in the market. So overall deals are getting bigger versus say a couple of years ago. And then the other piece is that the depth of the private credit market is growing. And when you combine those two factors, it's tough to predict exactly when, but are we going to see multiple private credit deals upwards of $5 billion? For sure, absolutely. And we're already seeing that.
If we were to talk specifically about Goldman Sachs' strategy and differentiation in the market, you guys have been active in the private credit market for multiple decades now. Talk to me a little bit about the inflection points that have happened along the way.
Sure. So, look, private credit at Goldman Sachs today is a 150 billion AUM business, close to 150 billion. We've got a publicly stated ambition that we are ambitious about this business. We want to double it over the next 4 to 5 years.
Okay.
And if you look at private credit at Goldman, as you said, it began in the mid-90s, so 1996, with our very first, mezzanine partners one fund, and that's a junior capital strategy that's continued to grow. We're investing, fund number 8 now. And then alongside that, we've been for close to 2 decades in the senior direct lending strategy across large cap, which is really a business that we think we pioneered. We are one of the first entrants into large cap senior direct lending, but then we also have mid cap direct lending. And then over the last few years, we brought these capabilities together with asset finance investment grade, our hybrid capital fund. And so, when you put all of that together, I think, it is definitely a core part of our strategy, it's a core part of our growth.
And as you think about the competitive positioning in this growing market, and you guys have been operating since mid-90s here, like what is the key differentiation now versus some of the other players that are out there in the market And what would you say? Is there a winning formula for Goldman in this market?
Yeah, I mean, I would say there absolutely is a winning formula. I think, we benefit from, I would say 3 core differentiators. I think the first is the history we've got with the business. So the 3 decades of investing experience brings with it a lot of investment judgment. It brings with it scale. Scale is a very important factor to succeed in private credit. So that's one. I would say, the second, which is related to the first one, is we've got a very large portfolio on both sides of the Atlantic and Asia. We're very ambitious about that region as well. And that again means that between the scale, the incumbency, the relationships we have within the ecosystem, whether that's the private equity sponsors, whether that's the borrowers, it means that we do get a differentiated sourcing engine. And then the third, possibly the most interesting angle we've got, is we obviously sit inside Goldman Sachs. So we do benefit from a tier 1 investment bank. We benefit from a lot of focus on private markets more broadly, including our capital solutions group. And what that really means is that the dialogue we can have with borrowers around private credit, public credit, multiple opportunities, senior debt, junior debt, is differentiated. So I think when you bring that together, you can create a winning formula where both the investors into our strategy can feel comfortable with the with the history of the strategy and the returns we've been able to create, and the borrowers can feel comfortable with dealing with us, and that really is the winning formula.
Amit, you alluded to the Capital Solutions Group, and it's a recent addition to the Goldman strategy. What motivations drove to kind of create that group? What unique edge does it give Goldman Sachs as it's competing in the market?
Sure, thanks, Dipish. I mean, the Capital Solutions Group, to my mind, is an evolution of the One Goldman Sachs strategy that our CEO unveiled, 5-6 years ago now. And what it does, and it was created in January of 2025, what it really does is it creates a group which is at the epicenter of private, public, credit, equity markets. It sits within our investment bank, within Global Banking and Markets. It works closely with our division, so the Asset and Wealth Management division, in ensuring that, given Goldman Sachs is at the epicenter of a lot of deal activity, we're the number 1 M&A advisor, we're top of the league tables across multiple financing products, we can go to our borrowing clients with a very holistic solution. That solution could be a public credit solution that the Capital Solutions Group is underwriting. It could be a private credit solution that me and my group is providing. It could be a hybrid of both. And then the borrowing client can choose. So it creates a very differentiated engagement with the borrowing clients.
Yep.
And what that means is that if I look at our investing clients on the asset and wealth management side, they benefit from that differentiated sourcing engine, the differentiated deal flow that we create. So it is a strategic imperative. It's brought together a number of groups within the investment bank, within the Global Banking and Markets private side division. And me and my division, we work very closely with that team on a day-to-day basis.
If you were to take now for the remainder of 2025, we're already in May. For the remainder of the year, given all that's going on, post-Liberation Day, the geopolitics, what's your prediction for the rest of the year? And the subdued M&A market that everybody expects is going to pick up and will pick up soon. What's your kind of crystal ball telling you?
Yeah, and I think you alluded to it, Dipish. Some of the volatility coming out of the Liberation Day. Let's see how that plays out. I think prior to that, we definitely were seeing a lot of rebound in sponsor M&A, confidence around more deals, more volume of deals, bigger deals. It certainly feels like that has not fallen off a cliff at all. So we're still seeing, April was one of the busiest months for us, certainly, across the market in Europe. So we're still seeing a confidence and deal volumes. I think what will be interesting to see in the second half of the year is as some of this volatility plays out and as there is a bit more certainty on the direction of travel for major economies, large deals. So I think that's the one bit which I'm certainly hoping, and by large I mean sort of north of 5-10 billion of enterprise value. In the sort of 1 to 4 or 5 billion EV range, I think we're still seeing a lot of activity. But I think we will see larger and larger deals as some of the potential macro risks can be boxed. I don't think those risks go away necessarily, but so long as people feel like there are range-bound outcomes and there are good businesses which need to be bought and sold, I do think we'll see that activity. The technicals in the private markets are robust. If you look at private equity dry powder, it's at an all-time high. If you look at private credit capital formation, it's also quite robust.
Yep.
And obviously, private credit's value proposition in the financing markets tends to go up when there's volatility. So, I think some of the backdrop of what's been happening could play in the favor of private credit financing even more buyouts for the private equity industry.
Okay, so let's talk a little bit about your personal journey into this market and how you've sort of evolved. So give us a sense of, the key moments that have shaped you, Amit, as, you've kind of grown in this.
Yeah, thank you, Dipish. So, look, born and brought up in India, moved to the UK in 2006. We actually did an internship with Goldman Sachs in leverage finance in 2005, and then joined the leverage finance team back full-time in 2006. Was lucky to get an opportunity to join the private credit investing team in the early part of 2008, back when we were investing the mezzanine partners fund. Was lucky to be there when we raised the first loan partners one fund, where it was really the first time a sort of a large pool of capital was raised to invest in senior secured loans, and that was at the wake of the sort of just at the eve of the GFC. So have had the pleasure of sort of working in this market for coming up to 2 decades, and seeing how the business has grown for us. I mean, the market has grown, the private equity industry has grown, and again, back to some of the themes we touched upon earlier, the size of the deals we're doing are bigger today than they were 5-10 years ago. The scale of the deal, the impact we can have in the financing markets is great. On a personal note, the team has grown. Very lucky to work with some very talented professionals. And the industry has really grown, right? Like even the term private credit or direct lending, 10 years ago didn't exist. And you guys are obviously testament to, an entity which is also pioneering the growth in private credit.
For all the people that want to get into this market, because as we discussed, from 1.7 trillion to 25 trillion, there's a lot of job creation that is still left to go in this industry. What advice would you give a person, let's say graduating from business school, graduating from undergrad, to what should they look forward to, what should they do to get into this market?
Sure. I mean, so reflecting back on my journey, I benefited from having some basic corporate finance training, both I was doing a master's in finance, and then also, the close to 2 years I spent in the leverage finance team. So I think that was a very good foundation. I think, stepping back sort of longer term, I feel, you need to have a growth and a commercial mindset if you want to make an impact in private credit. But because it's credit investing, you also need to have a risk mindset. So you need to have a little bit of tension between, I want to grow the business, I want to do the deals, obviously you want to have commercial impact, but equally you want to have a sharp lens on risk management and making sure that the underwrite you're doing is really downside protected, because eventually, a successful private equity investor, a successful private equity platform, a successful private equity deal is one which may not necessarily have the most growth potential or the breakout value, but is really downside and capital protected. And so I think, for any person looking at this from a long-term perspective, I think that orientation is important alongside obviously the growth mindset, because if you have just one and not the other, then you're not going to be an all-rounded private credit professional.